All right, we're live. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's about investing, personal finance. It really has a lot to do, though, with the simple things, common sense things, the day to day stuff. Investors spend so much time, I feel, looking for the big thing, the Sunday punch, that they forget that if they just are good at the day to day stuff, the mundane stuff when it comes to investing, planning, and personal finance, the big things will come their way. It's part of the process. But looking for big things is not part of the process. Okay. The big things, the making money in the market, the doing better with your money, the stretching your dollars, the saving more money, these are results of actions of following a process. That's what we need to talk more about. And that's where I think the focus should be. However, the real question I think people want to talk about now, and I don't blame them, is what's going on with the market. It's only been 2 days, but it was a little shaky at the end of last week, heading into the last few days of December. We had a good beginning of the week, and then things started to get shaky at the toward the end of the week. So the question is, are we are we at the precipice of a pretty steep decline? And judging by the looks of it, the AI type stocks, the big tech stocks, which have rallied so much, those look to be the ones that are taking the brunt of the sell-off. So people are concerned. I've made a lot of money in these stocks. We could easily give back 20, 30% of the gains from last year. And I think that prospect is a scary thing for a lot of investors. So investors start to lock in gains. The selling begets more selling, and it becomes a cascade, kind of like how investors went crazy stepping over themselves to buy. They may be starting to step over themselves to sell. I don't think we're there yet, but we could. And that's the problem with a tough couple of days. It looks the same and feels the same as the start of something bigger. So right now is the time when, as an investor, you have to have conviction in what you're trying to do. If the short-term gain was your goal and you want to lock some of it in, then take it. If you're like me and you're thinking, well, what about 5, 10 years out? I want to do even better. Then you don't take it. But you really have to know your style, your objective now. And you better know it now. You can't just be like, well, figure it out along the way, because now that stocks are going down and some stocks are giving back 10, 15, 20, $30 a share from recent highs, the giving it back of the gains, it's really adding up for a lot of you. So you really need to know what kind of investor you are. Should you do some simple rebalancing? Should you maybe move some of your gains into something else entirely out of stocks? Maybe a bond. Maybe a different kind of stock. Maybe small cap stocks or mid cap stocks. Maybe something outside of tech. There's a lot of ways to look at this. One way I look at this is to say, I'm not bearish on, I want to make sure I say the right thing, because I don't want to give blanket advice to all of you on a live stream. But if you do want advice that is specific to you, my phone number is at the bottom of the scroll. You see that? You can call me. You could check us out at clientfirststrategy.com. Reach out to us, give me a shout, and we'll have a one-on-one conversation that pertains to you. Maybe you should be the one who's selling now. Maybe you should be the one who's buying now. You don't know, maybe, right? And we need a strategy. Somebody who is going to panic and sell now is probably the same person who panicked and sold 3 or 4 months ago, bought everything back, and they're going to do it again. And that's a perpetually losing proposition. We need to break cycles. We need to invest in a way that you understand. And we need to invest in a way so that you expect down days. You expect your conviction to be challenged. No, I don't want to go by the kind of conviction where I'm talking about willpower. Willpower investing is not the way to go because willpower only lasts for so long. Willpower is stamping your feet saying you're going to do a certain thing at a certain time for a certain amount of time. But then the moment passes, emotionally you drain and willpower goes out the window. Anyway, I'm going to roll the quick intro, which is probably should have rolled about 3 or 4 minutes ago, but stick with me. We're going to talk about these things, very important stuff and things I think that could benefit you. So please stick around. If you don't mind, give us a thumbs up or a heart or an applause or a wow, depending on which social media platform you're watching on. If you're watching from YouTube, please subscribe. I'm here almost every day. And here goes the intro, and I'll be right back in about 20 seconds. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching our live stream. Be the boss of your money. Now, before you make a move based on what the market's doing now, think about making a move based on rebalancing. And those well, now I'm going to rebalance. That's what I'm going to do. And I'm not going to panic and sell. I'm going to call it rebalancing. And there, I did something productive. No, that's not what I mean. Your next move should be pre-planned. And that could be using limit orders, stop loss orders, buy limit orders. It could just be a quarterly or semi-annually or annually rebalancing plan. It could mean harvesting tax losses. It could mean at a certain age, you're going to move 3 or 4% of your portfolio every year into fixed income and cash. You need to know these things when you start today. If you come to me fresh today, I map out when we're going to do these things. It shouldn't be, well, the market's going up, so I'm going to hold on. Now the market's starting to get shaky. Should I sell? Should I not sell? Because you're basing the decision based on things that you have no control over. And it's probably going to be a negative outcome for you compared to being rules-based and pre-planned. That's how you manage money. Rebalancing annually is better than just saying, I'm going to hold on until things start to go down. And then things start to go down and you say, well, I'm going to wait till they go back up. And then maybe they go back up, they go down. What happens to someone like that is they wind up selling after things are down a lot. And then they wait to get back in at what they consider as a better time. But if things go lower, they're not going to invest because things are getting worse, not better. If things go up, they don't invest. Stocks go up, they don't invest because they could have bought lower. And it just becomes an endless procrastination that sucks up a lot of energy and a lot of time. We don't want that either. What we want is for you to make decisions based on your personal finance. Should you sell Apple now because Barclays downgraded the stock and the stock is going down? Well, all the big tech stocks are going down. I know. You hear on the news, and Apple, which was just downgraded by Barclays, it's not going down because it was downgraded by Barclays. It's going down because these stocks were up a lot. Investors took tax losses and put more money into the winners, especially fund managers who were chasing performance. They had to show that these stocks were on the books. They had to try to make up for lost time for having too much cash from earlier in the year when the stocks were a lot lower. And now that the year has come, they could take some profits. They don't have to worry about paying the capital gains taxes for a whole year. And now they could get back into their cash position and wait. And that might be suitable for them. I'm not buying and selling and making big moves with my finances based on 2 days of the market. I don't even do that based on a few years of the market. I don't do that based on what some strategist says the market is going to do or not do in the next 12 months. I do this based on my personal finances. The money I have invested now, I don't need. I'm going to need it one day. I'm going to rely on it. And if the stock market is lower in 15 to 20 years than it is now, I'm going to have a problem because the money that's not invested won't keep up with inflation. But that's the risk you take. I know my money will be eaten up by inflation if I just sit in cash. So I'm trying to do something about it, but I'm doing it in a way that I think is controlled, that's suitable for me. And when you have a plan in place, you take control. And I think what's missing is people have a sense of no control over the market. Well, actually, they don't have any control over the market. But you could have a sense of control over your actions, over how you deal with things. You know, I can't control if you get mad or not, but you can control how you react, right? Something like that. You've heard your mother say that. So that's a big thing. Should you rebalance now? I think investors should take a look at their portfolio and see where they're too much exposed, too little exposed. Now, if 50% of your portfolio now is in one stock because that stock went up a lot and you're comfortable with it, you don't have to rebalance. But the important thing is that you're making a conscientious decision of what to do. And if you're frozen and you decide to take a pass on making a decision today, that is also a conscientious decision. You decided to take a pass. Okay, maybe taking a pass is easier. You'll see what tomorrow looks like. Give it another week, maybe tomorrow morning, or at least the stocks will be back up because we've had 2 down days in a row. People get caught up in this. You know, maybe you should buy another artificial intelligence stock because I mean, if you have Amazon and Google and Facebook and Nvidia, you're exposed to artificial intelligence. I mean, those companies, Microsoft, right? Salesforce.com, aren't those the leaders of the technology, artificial intelligence? Now, you could look at more semiconductor stocks, you could look at more software companies, but eventually you just wind up with a portfolio that is filled with technology stocks. So if technology stocks do turn tail, you're going to take it on the chin. This is what happened to investors in the year 2000 when everybody had tech stocks / internet stocks. So how do you pick a mix of investments? These are the things that are important. One of the things that I like to do is I like to take my clients through a risk tolerance questionnaire. It's not any risk tolerance questionnaire. It's a special one, and I can send it to you. If you want to know your risk score, your risk number, kind of like your sleep number, but for your risk, if you want to actually know the number, not on like a scale of 1 to 5, what's yours, but on a scale of 1 to 100, what number is you? Are you a 44? Are you a 57? Are you a 66? An 88? Which one are you? If you want to know that, reach out to me and I'll send you the questionnaire and you can take a look at it. You're not obligated to use me. If you want to, you can. Maybe it's a good opener, a good conversation piece. What I like to do is I like to take that score and then score somebody's portfolio and see if they're in alignment. Quite often they're not, and then there's a problem. Why are you risk averse, but your portfolio is so risky? Sometimes people think if it's going up, it's not risky. These are the things we talk about. A lot of what I do is educational. I spend a lot of time educating clients. Like Cy Sims used to say, an educated customer is our best customer. I really feel an educated client is my best client because they understand what I'm trying to do for them. I understand what they want me to do for them. And you put those together, it's a pretty good feeling. Anyway, let's take a quick gander at the market. Dow down 285, NASDAQ down about 175, a little over 1%, S&P down 38 points. Not a terrible day. And yesterday, by the way, the Dow was up yesterday, and it wasn't that awful of a day. But people are making a big fuss because they got used to seeing the market go up so strongly, so consistently. Big worry today is liquidity coming out of the market. Investors have, shot their load and invested as much money as they have, which means investors are very bullish now. When investors are bearish, it's a contrarian signal typically because it means investors have already raised money and they're on the sideline so that money can go back into the market and lift stocks again. We'll see. There's always a little bit of bullishness and bearishness and money going in and out of the market. That moves the market around. It doesn't mean the stock that you own the companies that you own. It doesn't make them worth more or less. Yes, I know if the stock goes down of a company, if the company stock goes down, it means they're worth a little bit less. These are day-to-day fluctuations, but these companies are not changing on a day-to-day basis. An example is Disney. People talking on Bloomberg Radio today. Why isn't Disney going up? Bob Iger's back. He's trying to do everything he can because it takes time. It takes time to move a stock. You have to fix things at the company, follow the process, do things to improve earnings, raise revenues, cut expenses, invest in growth. These things take time to pan out. And when they do, if they do, earnings and revenues improve and the stock goes up. The patience level is so unbelievably low, but I think that's my secret sauce is I'm extremely patient. I could hold on to a stock for 15 years, not bat an eyelash. I don't get bored. I have other things to do, right? Gold down a little bit, oil up. Okay, strife in the Middle East. It was down yesterday. It was up today. There was supposedly an attack in an oil field in Libya, and there was a attack at an Iranian cemetery at an event to honor a general that was recently assassinated. For good reason, I think. So we'll see. We'll see what happens if things in the Middle East get worse. The Houthis are trying to attack every ship that goes by. They say that is affiliated somehow to Israel, but it's pretty indiscriminate what they're doing. Nobody wants to get involved, though. Iran does not seem to want to get any more involved than it is by backing Hamas and the Houthis. And of course, if Hamas gets destroyed, that sends a signal that Iran is not as strong as it is. So a lot of geopolitics going on, but Bahrain, Emirates, they don't want to get involved. Saudi Arabia, they don't want to get involved either. You know, they've got their own stuff to deal with. They're not. I mean, outside of Iran, believe it or not, the Middle East could be a pretty peaceful place right now, but it's always Iran. It's always them giving everyone a problem. It's that hornet's nest right in the middle. We'll see. Anyway, the VIX is up a little, not crazy low, but it's still pretty low. And the 10-year yield finished down at 3.92%. That's this one right here. Right? Excuse me, moving the cursor over the place right there. It did briefly touch 4% today, and if it goes over 4%, I think that's a sell signal. Remember what I used to say? 5% of the 2-year, 5% higher stocks go down. Now it looks like 4% on the 10-year stocks could go down. We'll see. So that's that. We're waiting to see what the Federal Reserve does. I think the selling now could exhaust itself by Friday, if not sooner. But the next catalyst is going to be earnings, fourth quarter earnings, and those will start coming out next week. And then you'll start to get commentary for early 2024 for the first half and what corporations see with their businesses going forward. And that'll really give you the next push or pull that investors want to get some kind of direction over the near term with stocks. All right, that's about it. Have a lovely evening. If you watch this in the live stream, I always appreciate it. If you miss it, you can always watch this in the replay because once I post this video, it's a live stream. So once it goes on my timelines, it's always there. So you can always refer back to it, watch it later on in the evening, and I hope you do. And if you have any questions about anything we talked about, ask in the comments. I will see those. I love hearing from you. And if you want to reach out to me to talk about things, to have a one-on-one conversation with me about your investing, your personal finance, your financial plans, Social Security, all those important things, you are welcome to reach out to me. I'd love to hear from you. Have a good night.